Hey guys, welcome to the channel. Welcome back to a live video. We're going to talk today about what smart investors are doing out here in the investment world. Okay. And I appreciate you guys. First and foremost, I appreciate you being here. But listen, we are living through a wealth reset right now. And most people are sort of just going along, no big deal, not really thinking on a level that I really want to see you guys think on as a smart investor, an intelligent investor. So, again, thank you for being here. I appreciate you spending your Thursday evening with me. Let's talk investing. Let's talk the stock market, right? As you come in, guys, to the chat, let me know where you're from, what city, what state, what town, what country, what continent, what hemisphere you're on. On today's video, I want to talk about this wealth reset, right? I want to talk about this wealth reset and what we can be doing from an intelligent investor standpoint as we look at the stock market, right? And investments, right? So I want to talk about this wealth reset. And let me know where you guys, let me know if you can hear me okay. Give me a thumbs up in the chat. I'm looking at the chat now, guys. I wasn't before, but Dog Whisper, appreciate you. Good evening to you, Fancy. Let's see. Hey, greetings back to you. Mrs. Moore's in the house. Mrs. Moore, thank you for being here, Mrs. Moore. So we do got a moderator in the house. If anybody gets out of hand or out of pocket, we can usher you right out the door with no problem. I appreciate you being here, Mrs. Moore. Dallas is in the house. Houston, Texas is here. I'm just giving a shout out to cities, countries, regions. Palm Springs, California. Jersey's in the house. Southern California, SoCal. We have Philly. Casey Moe is here. Good to have you. Always, this is the Kansas City Monarchs logo on the blue hat for the Royals, right? We got Louisville, Kentucky here. Thank you for the thumbs up. I appreciate it, guys. Yes, you can hear me. Excellent. I got this thing fixed. Last time I was here a couple of weeks ago, guys, we had some mic issues. No mic issues today. Detroit's in the house. Orlando. We got them all. St. Louis, we're all over the country. NYC is here. What borough? We got the 5 boroughs up there. Bay Area is in the house. Hartford, Connecticut's here. East St. Louis is in the house. North California, we got them all, guys. Quebec, Canada's here as well. So let me sort of explain this wealth reset. Appreciate you guys being here. Thank you so much. For the last, you guys can help me. And by the way, keep the chat flowing, right? I look at the chat, and if you have questions, we can do a little Q&A later on. But for the last, I'm going to say 12 to 15 years, right? 12 to 15, maybe closer to 12 or 13 years. Wealth in this country, in America, has been built on sort of cheap money. We knew for a long time. Let's think about interest rates for a long time, guys. Interest rates for a long time, 0%, 1%, 2%, almost nothing. That's cheap money. That's when money's cheap. Speaking of cheap money, money had got expensive, but it's starting to come back down. We got a Federal Reserve who's having a meeting here in a couple of weeks. Their Federal Open Market Committee meeting is coming up. And in that meeting, they're going to decide if they're going to make money even cheaper, right? We had been living on really cheap money, and then money got more expensive all of a sudden, right? And of course, we had the federal government open. By the way, if you haven't checked out my latest video, check out my latest video. We have the government finally opened. Thank goodness. Good for all the families that are needing and depending on what they need from the government. But listen, cheap money has been the order of the day for a long while now, right? And I would say now it got more expensive, but after COVID, right? But through COVID, right, we had what do we have? Interest rates for a long time were 2%. We had everybody got a stimulus check during COVID, and they pumped more money into circulation, right? And money was everywhere, right? Stimulus checks, PPP loans, everybody and their mother. I don't care. Almost, there were limits on it, but everybody was getting money, right? And then we have these tech stocks, which I want to hit on in this video, these tech stocks that basically could do no wrong, right? No wrong, right? No wrong, wrong, right? So in my opinion, guys, those days are coming to an end. And I think it's going to catch a lot of people by surprise. I really do. I think we are entering into a different sort of a different economy where cash flow is going to be more important than it was, where risk management, which is a big piece of what I want to talk about today, risk management is going to be more important than ever. And I also believe that true diversification, real diversification of your stock portfolio is going to matter again more than it has mattered, right? And we've seen that interest rates have crept a little higher, and now we see them hopefully coming down a little bit, but they ain't gonna get down to the 1% and 2%. I don't think it's gonna, I think it's gonna be a long, long time for that happens again. But the cost of debt is starting to get real again, and inflation. We know what inflation did back in 2022, summer 2022. Inflation went up to 8-9%, CPI 8-9.5%, right? But these things have quietly, I won't say quietly, but they've eroded what used to be considered real comfortable gains. Everybody was comfortable, right? But I think the easy money era is coming to an end in terms of our stock market, in terms of our investments, right? But here's the problem. Most people are still just investing and spending and doing what they were doing in 2019. But look, it's not 2018. It's not 2019. Okay. This is the reset. When I titled this The Wealth Reset, How Smart Investors Are Moving Differently, because this is the reset. A new now I will say new, that's the wrong word. An investing set of rules for building wealth as an investor, right? Tonight, I'm going to show you how smart investors are sort of doing this thing a little differently. And this is not groundbreaking. Okay. This is a good point to give a full disclosure. Okay. Before we jump in, let me give a disclosure. Nothing I share tonight is financial advice or any recommendation for you to go out and buy something or sell any of your investments. No, I'm not a financial advisor, and your situation may be completely different from mine and from everybody else's, right? This live is for education and information only, right? My goal is to help you think smarter about investing your money, smarter about risk, right? Always do your own research, right? Now, let's sort of jump in. Let me go back to the chat. We got the CP Live. What does that mean? Let's see. Hello from West Palm Beach, Florida. Got you here. Good to have you. Let me see here. Welcome, by the way. Welcome, IG. Welcome, obviously, YouTube. Welcome, Facebook. Welcome, LinkedIn. Glad to have you guys. We're on a lot of different platforms today. So let's talk about the total dominance of tech. Let's talk about it. I did a video a couple of weeks ago, a week ago, about how the S&P is so tech heavy right now, more than it's ever been before. So I want to talk about the total domination of technology in the stock market, right? Technology has completely taken over many markets, right? Let's just be real. I've talked to hundreds of people about their money. And I'm gonna say this. I would say that of those who are invested, 75 to 80% of the people who are invested that I've talked to, invested in the stock market, they have I would say they have a whole lot of technology in their portfolios. The people that I've talked to, a whole lot of technology, right? Now, I hesitate to say too much technology, but there's a lot of technologies. There's a lot of people just banking on the fact that technology is going to continue to do what it's been doing, right? Over the past decades, let's say 10 years, 12 years, 10 or 12 years, the big winners in the stock market have been who? Apple, right? Amazon, big winner. I remember in 2013, man, Amazon was not nowhere, I won't say nowhere near, but it wasn't where it is now for sure, right? NVIDIA, last 3 or 4 years, right? Google, Alphabet, Meta, huge. All of these ginormous companies have basically carried just about all of the stock market's growth, right? Here, let me give you an example of that. Okay, let me just give you an example. So right now, the S&P 500 year to date return is around 16.4%. The S&P 500 year to date is 16.4%, right? That's huge. That's nice. It's wonderful. But here's another stat. Let me balance that out for you. The S&P 500 year to date return is only 7% without the Mag 7. The Mag 7 is the top 7 big companies. I just named a bunch of them, right? You take out that Mag 7, the S&P 500 only has a year-to-date gain since January of this year of only 7%. That should give you an indication of how top heavy, and it's in the S&P 500 is a weighted index, right? But it should give you an idea of how top heavy the S&P 500 is, right? 15 years ago, 20 years ago, S&P 500, well diversified. Yeah, tech is pretty large, but it's only 14, 15%. That's changed. Now, all the Mag 7 is basically tech. And if you take the top 10 companies, you're talking about 38, 39% of the overall S&P 500 is technology. So tech's market value has exploded, and so has its influence, right, on us as investors, right? Investors have come to believe that tech always wins. Here's what I'm telling you on this video. The reset is, let's rethink that ideology that tech always wins. We have to reset how we think, or how we've sort of been conditioned to think based on market indicators, based on all the stories and things that we see on social media all the time. Look, nothing keeps going, okay? Let's reset. Nothing keeps going. Trees don't grow to the sky, right? It's even a tree at some point stops growing, okay? So what worries me about a lot of people, and this is why I want to have this conversation about smart investors moving differently, is that people think tech is going to continue to carry the market for the next 20 years, right? You need to be cautious. Let me put a full stop on real quick. Full stop. This is part of what I'm going to have a conversation about next Thursday. And I don't think I really mentioned it, but I'll mention it here. Next Thursday, I am doing a workshop, and I'm going to tell you a little bit more about the workshop later. But the workshop I'm doing, I'll put the link in the chat real quick. The workshop I'm doing is going to dig deeper than what this video will dig, right? This video will talk about a couple things, but we're going to go way deeper next Thursday. I put a link in the chat. If you want to check out the workshop, you're more than welcome to come check it out. But we're going to go much deeper in this whole topic, right? But let me get back. I just want to say that real quick because I forgot to mention it up front. When one sector dominates as much as tech is dominating, it creates blind spots for all of us regular investors who are just kind of going about our way, watching the news or watching our social media feeds or what have you, right? We start to confuse, innovation with invincibility. It's invincible. It's always tech is going to be. I heard people say in my comments on my video about the S&P 500, tech is going to be good for the next 30 years. Okay. I mean, the stock market is 120 years old or so. Can we name a sector that went straight through for 40, 50 years straight? I don't know that we have, right? We can, right? So this is why I want to introduce to you a concept that 99.9% of all internet gurus who talk about money, all these personal finance people who are putting up these videos about money, almost none of them, I say a few of them, but almost none talk about this concept that you need to know as an investor, and you should have known the very first day you thought about investing. And of course you've heard about it, but nobody talks about it. Nobody digs deep into it. I want to dig deep into it. Not just in this video, but also in the workshop. I want to dig deep into it. But it doesn't, here's the deal. This phenomenon I'm going to talk about in just a moment, it does not get clicks, right? It doesn't get people to click on your video so they can watch you and they can and you can make money because of ad revenue. And listen, So you don't see this talked about on YouTube. And if you do search this on YouTube, you'll find it, but every video you find about it will have about 100 views, 300 views, 2,000 views, because it just don't get views, but it's very, very important, right? And again, everything I'm sharing tonight is something we're going to drive much deeper into next Thursday, okay? Now, this is the thing. Let's jump into it. This is the thing that almost none of the money gurus mention. They don't talk about it, but that is risk. It's risk. It's risk management, right? They don't talk about risk management. And if you ever see a video on YouTube about risk management, it ain't going to have very many views on it because it ain't clickable. And if it's not clickable, you're not going to see it on the internet. You're not going to see it much on YouTube. Now, you can take a class at your local community college, but other than that, nobody's talking about risk, right? But risk is the foundation of everything you do as an investor, everything you should be doing. Risk management is huge. Remember, this is how smart investors are moving differently, right? The problem that is created by tech's dominance over everything in the market right now is that a lot of us have just thrown risk out the window, and we don't talk about risk. We don't think about risk. We kind of subconsciously think about it, but we don't think about it and consider it enough, right? People, here's what happens. People think, oh, I'm diversified. Yeah, I'm real diversified. Yeah, I got S&P 500. I got NVIDIA. I got the NASDAQ 100 ETF QQQ. I got all this. Yeah, I'm real diversified. No, that's not diversified. You got all this overlapping stuff. Everything in the portfolio is connected to tech, and you think that you're diversified when 90% of your portfolio is in one sector, called the tech sector, right? Right? You can't have 60% of your money in the S&P 500, 20% of your money in QQQ, and have NVIDIA and have Broadcom and then have some Coca-Cola in there as well. And that's not diversification, right? But this is what people think, and this is how a lot of new investors mess up. They don't consider diversification. You're just not diversified. If you got S&P 500 and you got QQQ, which is QQQ is the ETF this really follows the NASDAQ 100. And the NASDAQ 100 is a technology index fund almost. It's a technology fund pretty much, right? Because it's super tech heavy. So if you got the S&P 500 and you got QQQ, and then you have NVIDIA, and that's your only things you have in your portfolio, you're very, very heavy tech because the S&P 500 is heavy tech. And then you got a tech ETF, and then you have a tech individual stock, right? So this is the mistake that a lot of people make, and nobody is out here telling or teaching or talking to you about how to look at risk as a smart investor, right? So tonight let me just clarify this. Tonight is not about avoiding technology. I'm not saying avoid technology. I don't want you to think that. Tonight is about avoiding the trap of thinking that tech equals safety, because all of your ducks or all of your eggs in one basket, that's not safety. Even though everybody has told us tech is going to be around for a while. Tech is growing incredibly. Tech, right? It's a classic setup for one of the types of risk that I'll talk about next week in the workshop. And that's over concentration, or some people call it concentration risk, right? Concentration risk. Let me just run over here to the chat real quick before I dig deeper, because I'm going to go a little deeper on that. Let's see here. It can't be the boom, boom, boom. Yes, Rich. Let's see. You guys can hear me okay, though, right? Let me see. Let's see here. Boom, boom, boom. Yeah, looks like we got somebody we got to get out of here. Is that right? Help me out. Help me out here. Anybody acting up, we just ban you from the channel. That's all I do. Just ban you from the channel, because there's no need for it. Let me see. Let's see here. I could make a video about how to invest $2,000 from the stimulus check. Huh? Stimulus checks are over. Let's see. Worry about money. I worry about. Let's see. Oh, thanks for the thumbs up. Appreciate you. Okay, so you can hear me well. All right. So nothing in the chat, no questions. Cool. But if you have a question, I don't mind answering it as well. So concentration risk. In the workshop, I got 11 more of these types of risks that I want to break down to you. All right. So let's talk a little bit about why risk, or the consideration of risk, is really the heartbeat of intelligent, smart investing, right? And how, if you want to be a smart investor, intelligent investor, you got to be thinking about risk. A lot of people don't think about it, guarantee you. Think about this. If you have, how many of you have a financial planner? Give me a 1 in the chat if you have a financial planner. Just give me a 1 in the chat if you got a financial planner. Let me see how many people out here are actually using a full-blown, and I'll get to it. I'll get to exactly what concentration risk is. I will. I'll dig a little deeper here. Let's see here. Hey, glad you're here. Let's see here. South Africa? Yeah, South Africa's in the house. Give it. All right, so some of you have a financial planner. Now, I'm going to show you how important risks are, okay? Because of this financial planner. When you first meet with a financial planner, 9 times out of 10, what's the very first thing they do with you? The very first thing, they either ask you or they give you a worksheet with questions on it to figure out what's the first thing the financial planner wants to figure out about you as an investor before they go and they take on you as a client to help you with your investing. They got to know one thing about you up front. This is what they need to, they give you a worksheet or they sit you down and ask you some questions because the very first thing they're trying to figure out is what? I think I saw it in the chat. The very first thing they're trying to figure out is not your monthly income. It's not your net worth. It's not your financial goals. The very first thing every financial advisor is trying to figure out about you is, what is your risk tolerance level? Right? How can you stand risk? Can you take risk? Do you want to take risk? Do you not want to take any risk, right? Are you risk averse, or can you tolerate a lot of risk right now? That's the very first thing that they ever want to know about you. But guess what? How many risk tolerance videos have you seen come across your feed on YouTube? How many risk tolerance things have you seen come down your Facebook feed or your Instagram feed or your LinkedIn feed? Not a whole lot. Maybe a few on LinkedIn, but otherwise ain't nobody talking about risk. But every time you meet with a financial planner, the first thing they got to know about you is, what is your risk tolerance? Right? That's the very first thing they want to know about you. That's how important risk is to your investing. Right? And that's one of the reasons why I want to tackle it. Right? I tackle it. We're talking about it here, but we'll talk about it much deeper next week. Right? Because how you think about and handle risk, how you think about risk and how you handle risk should determine how you invest. But guess what? Most people I've talked to, they're not really thinking consciously, intentionally about risk when they're investing, right? People often will throw caution to the wind because they heard Kramer talk about a stock. Or they'll throw caution to the wind because their favorite YouTuber mentioned a stock that they ought to look at and buy. People are buying stocks based on what YouTubers are telling them to buy, as opposed to assessing their own risk or the risk that is involved in a particular stock or a particular asset class, right? People have crypto and they don't even know the risk of crypto, right? And sometimes part of that is because it's so easy to invest, right? Now watch this. When people invest in real estate, real estate is a whole different thing, right? People will be overly cautious, right? And think about every possible risk scenario before they invest in a piece of rental property, because it costs more, it takes more time, it takes more energy, and it's a bigger lift, right? Putting $25 into a stock is not like putting $25,000 into a rental property. So when people have to sit and think about an investment, they'll dig all into the risk. But in terms of the stock market, it's too easy. And people don't even consider risk quite often, right? They make unresearched decisions and emotional decisions, but they don't make decisions based on risk, right? Now let's go back to over concentration risk, right? Concentration risk or over concentration risk is simply when too much of your money sits in one stock, or too much of your money is sitting in one sector, right? Your whole portfolio is energy stocks, right? Or your whole portfolio is energy stocks and let's call it industrials, right? You got all of your stuff sitting in only two sectors right there, right? Or, but you get the point. Even when you think you're diversified, today that danger is living in tech right now. People think tech will just shoot to the moon and never stop because they've watched Nvidia go from, or Palantir go from last year when we were doing these videos about a year and a half ago, Palantir was trading at about 18, 19 bucks, right? People have watched the tech sector, certain stocks in the tech, go crazy. Nvidia 4 or 5 years ago to now, go crazy. And people have jumped on it in an emotional way, right? Right? So, and the other thing is tech's proliferation in everything we do. Let's be honest, right? Tech is in our job, tech is in our retirement, tech is in the index funds that we have, tech is in our side hustles, tech is in, the grocery store down the street, right? It's everywhere, right? But you got to remember, guys, over concentration is a risk. It's not diversification. It's more of, let me just believe the hype. Because if I was to ask you, what is the PE ratio of Broadcom right now, you may not know. If I was to ask you, what is the what is the free cash look like for Nvidia as a company? You may not know the specifics and details of the company, but you know it's hyped up. You know everybody's buying it, right? And so we believe in the hype as opposed to really doing our research and due diligence and digging into the risk. Over concentration really breaks a lot of portfolios. Okay. And if you've only been investing for 3 or 4 or 5 or 10 years and you've been in tech the whole time, you haven't seen or experienced this yet. But it happens. Right? Over concentration in something like tech has a way of making you feel safe because everybody's doing it and all you've seen it goes up. But really what it's doing, you're exposing your portfolio to some problems, right? So let's talk about this. How do intelligent investors protect themselves from, say, concentration, over concentration? I'm gonna give you a couple of these. What we call a risk mitigation strategy, right? What intelligent investors do to avoid the over concentration risk, right? Here's one. Let me just give you one. And let me go back to the chat real quick because I get to flowing, guys. You gotta work with me. I get to flowing about this stuff. Let's see here. What's a proper diversified portfolio breakdown? It depends on a lot of factors. When do you need the money? How old are you? What is your risk tolerance, right? How much money are we talking? We talking $5,000? We talking, 5 million? There's a lot of factors. So to give you one proper diversified portfolio breakdown, that's difficult to do. Right? We could say 80-20, right? 80 in equities, 80 in stocks, and 20 in bonds. We could say 60-40. We could say 60-20-20. There's a lot of different theories out there, right? But a lot of it depends on a lot about you personally. Personal finance is personal, right? Let's see here. Let me see if there's any other question I can get on. What are your thoughts on cryptocurrencies and more specifically? I'm not a big crypto guy. I don't have a lot of crypto in my portfolio. I have a tiny, tiny, tiny percentage of my portfolio that is crypto. And I plan to leave it that way for now. And it's mostly Ethereum, by the way. Let's see here. Technology is now building Africa, South America. Okay, cool. NVIDIA products is outperforming the others. Absolutely. Hey, how you doing? Somebody said, hey, good to see you. Let's see. Thank you for the knowledge. I really enjoy your podcast. I appreciate you watching and I appreciate your support. Live from KC. Good to have you right in KC. Are CDs a good investment? Depends on a lot of different things, right? Do you plan to use the money right now? If you're older, if you're over 50, 60, 70 years old and you have some CDs or using the stack method on CDs, it can be okay as a part of your portfolio, right? Maybe not as your whole portfolio, but a part of it, right? So let's talk about this. What smart investors do is they create rules, okay, to make sure their portfolio is not over concentrated. They create rules before they buy. Let me say it a different way. You build an exit strategy before you purchase or buy a stock. This is one way to mitigate, right, or to protect yourself from over concentration. You come up with an exit. It's the same thing I would tell somebody, because I've owned rental properties for a lot of years. Okay. Same thing I would tell somebody about owning rental properties. What is your exit strategy before you purchase the property? Right? How can you get out of it if you find out something is going on that you don't like? Right? Is there a 30-day window, a 45-day window with a contingency contract on it? Whatever it may be. Same concept for stock picking. Stock picking, same concept. Build yourself an exit strategy on paper before you make the purchase of a stock, right? Now listen, well, let me see if I can put that back in the chat. Bam, I just put it back in there. We're digging deeper into this next Thursday. I don't want to give away too much, but we're digging deeper into it next Thursday. Feel free to click that link that I put in there. Okay, so here's what happens with a lot of people in terms of investing. A lot of people lose money in terms of investing because they don't know when to get out. They don't know when to sell, get rid of a stock and leave a stock before it goes down. And if you look at examples from the 70s and 80s and sometimes the early 90s, you'll see a lot of stocks that were doing well and weren't doing well. The problem with a lot of people is that they don't know when to get out of a stock, right? They just don't know when to sell before they lose. So let me explain what I mean by an exit strategy. You need to ask yourself before you buy a stock or before you buy an investment, when am I going to take the profits off the top? Right? And you take profits off the top. What I mean by that is, when am I going to sell high? Right? Or if I'm never going to sell high, I'll buy and hold is my strategy. That's cool too. Right? But you ask yourself before you buy the stock, at what point in the stock price do I sell? Right? You buy a stock for $200 per share and you say to yourself, okay, when it gets to 210, okay, I'll take some profits off. When it gets to 220, I'll take some profits off. The other question you need to ask yourself before you buy a stock is, when do I cut my losses? You come up with this in your brain, right? And then you write it down. And a lot of people have this in their mind who do some trading and so forth. But I'm telling you, as a regular investor, as an investor in the stock market, you need to be doing this when you purchase stocks. Not only doing your research, your due diligence, you're learning about the company, you're setting up a checklist, right, on what you want to buy, when you want to buy it, how you want to buy it, what's the quantitative things you're looking for, what are the qualitative things you're looking for when you buy a stock. Besides all that, right, you figure out, when am I going to sell, when am I going to buy it, when I buy this stock, if I buy this stock, right? What data is going to trigger me to either buy more shares or to sell stock or to, right? This is what you got to be thinking. You got to have this conversation before. You can't just read an article on yahoo.com and go buy a stock, right? That's not smart investing. That's not intelligent investing. You got to have written rules for exits. Why? So that your emotions don't make a decision for you. The worst thing you can do in the stock market when you're investing is letting your emotions dictate your moves, right? You don't want emotions to dictate what you're going to do in the stock market as an investor. That's not intelligent investing. That's emotionally investing. And when you invest emotionally, you're liable to make some mistakes, some big mistakes, right? Here's the other thing. If you know your exit from a stock, then you're less likely to panic, right? People lose in the stock market all day long because they ride winners too long and they never plan an exit strategy from that stock, right? Let me give you another, because a matter of fact, I have about what do I have? 6 or 8 of these different different 6 or 8 of these different mitigation strategies that I'm going to share next week, next Thursday at 7 p.m. Let me give you another one. Another one's called the guardrail strategy. A guardrail strategy is sort of a strategy that keeps your portfolio from drifting into the danger of overconcentration without you really realizing, right? Just like when you drive on the highway, you got these guardrails, right? So here's what guardrails are. You set a max for any one stock, right? When I say max, I'm talking about a percentage of your portfolio. You say, look, I don't want to have more than 5% of my portfolio into transportation stocks. No more than 5% of my portfolio into technology stocks. No more than 5% of my portfolio into energy stocks, right? So you set a max for any one stock or sector that you're going to have in your portfolio, right? That's a nice guardrail to set yourself up. That way you say, hey, look, if tech crosses the 20% mark, it's time to trim, rebalance, whatever it may be, right? And you can set a limit for your high risk assets. Like earlier, I said I own some crypto, but I may only own about 2% of my portfolio's crypto. That may be my limit for crypto. Maybe I only want to have 10% of small caps in my portfolio. I set that limit. That's a guardrail, right? I don't want to have, me personally, I don't want to have 90% of my portfolio in small caps, right? So I kind of have a percentage. I'm not going to go above this percent of small caps, right? So technology, the overconcentration in the tech sector has really made people forget about some of these intelligent investing ways of looking at the stock market, right? So again, next week, 12 different types of risk, right? It's 6 different mitigation strategies or systems, right? 6 ways to handle and manage and prepare for risk, right? You cannot avoid risk. Anytime you're dealing with money investments of any type, there's always going to be risk. You can't avoid risk, but you can prepare for risk. That's what we call mitigating risk, right? Let me go back over here to the chat. Anybody, if you got a question, this is not a long live, okay? I'm just introducing this information to you guys, right? I'm just introducing this information to you because you don't get this on the internet, right? And when you get it, the video is 3 years old and it's got about 500 likes or 500 views. Nothing wrong with a 500 view video, but it's like it's old information. But this is what we should be talking about if we want to be investors, right? This type of stuff, right? And that's why the 2-hour session we're going to have next Thursday is so important, right? And next week, I'm also going to, I don't know if I mentioned it, but I'm also going to give you 8 golden rules of intelligent investing that you need to invest by and live by in terms of your investing, right? So let me go over one of them. Okay, one of those golden rules is that we sort of talked about is diversify your portfolio intelligently. Don't just diversify, but diversify intelligently. You don't need 20 ETFs, right? You don't need 10 different index funds. You can if you want your portfolio, but do you really need it? Most people think they're diversified, right? A few funds, a little crypto, some bonds, but a lot of that stuff might be holding on to the same stuff, right? I got 3 different ETFs. I got VTI, I got VOO, and I have QQQ. Oh man, I'm doing well. I got 3 ETFs. I'm well diversified, VTI, VOO, QQQ, but 40% of all that is overlapping. It's the same thing. And you got all this activity going on, but it's just duplication. Duplication is not diversification, right? So intelligent diversification means spreading your risk across different engines of growth, right? The healthcare industry, real estate, some cash, some tech, right? Not 80% tech, right? It's because here's the deal. Your investing goal is not to own everything, right? It doesn't have to be that. Maybe it is, but it doesn't have to be. Your investment goal could simply be to make sure that no single sector or stock or political policy or story can wreck your investment portfolio, right? If one single story that comes on the news tonight can mess up your portfolio, you're not diversified intelligently, right? Remember though, activity, we say it like this, activity doesn't equal progress, right? You just because you own 20 different things in your investment portfolio, it doesn't mean you're diversified if half of it is concentrated in one area. Okay. So I hope I hope you guys are kind of getting what I'm saying here. Let's see here. Let me see any questions out here. Life insurance or stocks? Uh, in terms of what, Steph? Life insurance or stocks? You need life insurance, period. In terms of an investment product, stocks over life insurance. I don't like investing in investments in my life insurance. I like to keep them separate. Now, if your net worth is $2 million, $3 million, $5 million, okay, there's some insurance products that you could probably use to help you preserve your fortune. But if you're the problem with insurance, let me just go here since I'm on it, right? I get on these tangents, right? So the problem with whole life insurance, let me just go to whole life, is that whole life insurance is marketed to poor people, but it's really for rich people. It's really for people who have assets and can do some of the various things with the whole life policy, not for the person who's struggling and making $40,000 a year. But now you have them, the life insurance person has agent has you paying a $500 a month policy, and you only make 40,000 because you're trying to build up some. No, no, no. Whole life policy is for people who have money to use strategically, right? If you don't have a whole bunch of money, don't get a whole life policy. But I would say between insurance and stocks, I'm going stocks for investing, right? For most people. Let me just look and see if we got any more questions in here, guys. Let me see if there's any more questions in here. By the way, I got a new book out, man. I don't know if you guys have saw it, but it's Manage Your Way to Millions. And you can go over to manageyourwaytomillions.com. I think I'm putting that in there, right? Manage Your Way to Millions.com. I think I've just put it in the chat. Click on that. All right. I got a new book that's over on Amazon right now. It's doing really well. It's the Kindle version now. In the next week or less, we're going to have paperback version and we're going to have hardback versions out there as well. But check out that book, manageyourwaytomillions.com. It's all about money management. Very, very solid. Okay. So we got a lot going on. We got the workshop next week that I put in the chat earlier. I think it's at the very top of this chat if you want to go all the way to the very top. But we also have our book that just came out as well. And we're probably going to be offering a special on the book this upcoming weekend, even though it's the Kindle book, still probably offer a special starting tomorrow for 72 hours on that book. Pretty inexpensive book as well. 117 pages, easy, good read, solid. It's in my voice. I'm talking just like this. I wrote. So let's see. I'll be 62 years. My portfolio consists of 3 REITs and 3 ETFs. As long as you don't have, check. Here's a good idea. Go to ETF.com. They have a overlap tool, a ETF comparison tool. Go to ETF.com and go to that comparison tool and plug in your ETFs and see what type of overlap you have. Overlap just means how many of the same stocks are in both of them, right? So a lot of times when we get to ETFs, there's a lot of overlap in ETFs in terms of what people are invested in. So you want to check that out as well. But 3 ETFs and some REITs, that's cool. I have no problem with that portfolio if it works for you. VTI and VOO definitely overlap. Look, if you compare the VTI and VOO, you'll see their performance is just about the same over the history, 10, 20, 30 years. Small, mid cap, large cap, and global ETFs. Let's see here. What is a good international mutual fund? Let me just, can I share something with you guys? If I can share this with you about international fund, Ray, give me a thumbs up if you're okay with me sharing this real quick. Just give me a thumbs up. I like interaction, right? Make sure you guys are with me. If you wanted me to share that, I have a thought about international. Let me see. I haven't got a one yet. So maybe you guys don't need me to share that. Let's see. ETF.com. Grizzly, you're right. Audiobook is coming too. That'll be about a month from now. Okay, here's the deal. International funds. I don't particularly have a lot of international funds. I don't think I have any. I might have a little bit in my Fidelity, but I don't have any real solid investment in international funds. Why? Because a lot of the funds and stocks I have, they're worldwide stocks and worldwide funds, companies that dominate those funds. So I don't really get too much into international too much, and I've had some over the years, but I've since got rid of quite a bit of international. Just not a big. Let's see. Can you please replace the link? I came in late and cannot access it. LinkedIn. If you go over to YouTube, Smart Money Bro on YouTube, you can watch the full broadcast over there. All right. Let's see here. Quantum computing versus AI stocks. Both of them are going to be big in the next several years. I do like the AI sector though. The AI subsector of technology. I do like that. Yeah, not a big crypto owner though. How do you feel about investing through the bank? What types of investments through the bank? Are you talking about CDs, money markets? Are you talking about something a little more in depth? Depends on your bank, depends on who you're dealing with at the bank, and what they have you in, or what you have yourself invested in. I want to know about international currency funds. I don't know too much about international currency funds, and I don't want to lie to you and say, oh yeah, we could. No, I don't have a lot of international currency funds. Appreciate all they do for us average Joes. Thank you for the knowledge. You're very welcome. Did I miss the term life insurance advice? No, you didn't miss it. It's my advice was I like term over whole life for most people until you get to where you're self-insured, right? You've got 500,000, a couple mil laying around in your overall net worth, that's not tied into, a $800,000 home that you live in, right? I mean, investable $1 million as opposed to having it tied up in real estate. So this was the gist of tonight, guys, the wealth reset. This everything I talked about here is how smart investors are moving differently, right? The rules are changing. It's not just let me look at an article and go buy it. You got to do your due diligence. You got to plan for risk up front, right? And you got to reposition yourself to start thinking in an intelligent investor mindset as opposed to just somebody who's buying some stocks, right? Diversify intelligently, set guardrails, plan your exit before you buy a stock or an investment, right? Again, next week, I'm going to be going in the workshop 12 different types of risk. I only gave you one on this video. I'm going to go over 12, right? And bring your pen and paper, okay? Because we're going to be really digging deep. We're going to go over all 6 mitigation systems, okay? And then we're going to go over all the 8 different golden rules, including a couple, or one of the ones that I talked about today, right? So that you can start to think and move like an intelligent investor, not just somebody who's out here copying Kramer. Does anybody copy Kramer anymore? I know that was a thing 10, 15 years ago, but that's not where you want to be as an investor, right? You want to be digging deep, qualitative, quantitative. You want to have a checklist, right? So the link to the workshop is in the chat. If you have a question, let me know, because I got just a few minutes and we'll answer a few questions here. UILs, okay, yeah, but again, I still like doing my investing and investments and doing my insurance and insurance. I'm 51 and have a $600,000 portfolio on top of my 1.7 home. Is that good? That's wonderful. That's wonderful. That's a lot of house, right? 51 years old, that's wonderful, right? I'd like to see by the time you get to 61, turn that 600,000 into about 2 mil, right? In the next 10 years. That's very, very possible, right? With smart investing. Any advice for 18 to 30-year-olds? Just scroll back through or listen to the very beginning of this broadcast. If you really want some help as an 18 to 30-year-old, follow my channel, because I'm going to give you the real. I'm not going to give you just a bunch of stuff to get a bunch of clicks and all that type of stuff. I'm going to try to give you the real that's going on. Smart Money Bro, thanks for your financial guidance. I now invest $1,215 a month in the stock market. Congratulations to you, Larry. But do you think it's a time where you should be doubling down on investments? Yes. Listen, I'm a buy and hold strategy person. So if I'm a buy and hold person, It's for me, investing is not a matter of when. I'm not trying to time the market, right? I'm not trying to get in and get out. And no, I'm not that smart. Okay. 99% of the people on the planet aren't that smart, right? So it's not about, is it a good time, or you're asking the wrong question. The question is not, should you be doubling down on investments? The question is, wait a minute. The first thing is this a buy and hold strategy? If it's a buy and hold strategy, just dollar cost average into the market. Every 2 weeks, put $200. Every month, put $800 into the market every month, right? Clockwork. The real question is, how should I be diversifying my portfolio based on my risk tolerance and my long-term goals, right? That's the real question. The real thing is, okay, here's my checklist for what I buy, when I exit. Is it meeting, are these stocks or these ETFs meeting my criteria? You got to have a checklist. You personally, not my checklist, but you got to have a checklist. Okay. So that's one of the things I talk about in my course for the 4 steps to maximize your money. In that 4th step of money multipliers, coming up with a checklist of your own with quantifiable things and qualifiable things in terms of how you measure an individual stock. What are you looking for? What's most important to you? Those are individual conversations that you need to develop your philosophy about investing based on your core beliefs, your core values, what you think about businesses, etc. Right? But that's a big part of what you should be doing, and saying, you know what? Let me come up with my own my own philosophy in terms of investing. Not Susie Orman's or Dave Ramsey or Smart Money Bros, but yours, right? If you're interested in that course, I went ahead and put the URL to that. It's just smartmoneybro the letter u.com, smartmoneybro.com. But that's a big course. It's over there. It's available. You can tell I got a lot of stuff, right, for folks. Let's see here. Not sure if you said it already. Do you think it's okay? I just read that. Sorry about that. Let's see here. Working on it. Good. How to get a home loan with bad credit. First of all, if you got bad credit, I got news for you. If you got bad credit, you probably don't need a home loan. You probably need to clean up your behaviors with money, and then you need to clean up your credit, and then go out and get a loan. So I don't mean to be mean to you, but I'm just saying, if you got bad credit, let's work on the behaviors that cause the bad credit, and then we can work on the credit, and then we can work on our strong foundation with money, starting with our mental philosophy on how we manage money. And then we can look at getting a home. If you got bad credit, you could be about 2 or 3 years away from getting a home. Listen, I'm a straight shooter, so sometimes that rubs people the wrong way. I hope that didn't rub you the wrong way. I'm just being honest with you here. Let's see. Who's the best investor of all time? I don't know. Let's see here. I'm just seeing if there's any more questions that I could jump on. Let's see here. What do you think about $2,000 paycheck? Is it going to happen in your opinion? Oh, the $2,000 check that I think President Trump's, I don't know. I have no idea. I'm not going to rely on it, but I don't know if that's the greatest idea or not. Let's see here. Any other questions? What do you think about the two? Okay, I just read that again. I'm repeating myself. It's not easy, but I'm in it for the long run. Okay, look, smartmoneybro.com. Listen, here's the deal, right? Next week, I would love to see as many of you as possible in the workshop, right? Where we're going to spend 2 hours. It may be a little more than 2 hours, not sure, but we're going to spend 2 hours digging into these risks and how to mitigate these risks and how to invest intelligently, right? As a smart investor, right? We're going to dig deep and go deep. We'll do a little Q&A in that as well, but for the most part, it's all about just learning, because I run into, here's how this came about. I run into so many people who, when we look at their investment portfolio, it's like, okay, what are we doing here? What's the game plan? What's the philosophy? You might want to move this around and this around. Just think about this, because And so I meet so many people whose portfolios are they need some tweaking. Let's put it like that. They need some work. And I said, this is a solid opportunity for me to reach out and have a small crowd in a workshop where we can really dig deep into this idea of risk and considering risk and research to do your investing. And that's why this workshop came about. So I just wanted to introduce this information to you tonight, right? By saying, hey, we're talking about this in detail, but here's sort of what it is. Over concentration risk is only one of them, right? There's all different types of risk, recency bias. We can go more into them, but we'll talk about them in the workshop. Listen, you guys have to. I'm just looking at them. Sorry about that. When can you take out of your 401k without getting penalized before age 59? I finished that question for you. Check out the rule of 55. Okay. Just do your research on the rule of 55. Google it right now if you want to. The rule of 55, when you can take out of your 401k before age 59 and a half without, you still got to pay your taxes, right? If it's tax deferred, but you can start withdrawing your money and not pay the penalty prior to 59 and a half if you follow all of the tenements in the rule of 55. I'll let you look at that. There's also the 72T rule as well. Might look that up. Google that one too, right? Let's see here. If there are any more questions, not sure about FistServe. I'd have to go ahead and do some research on that. Let's see here. Do I follow? I like Dave Ramsey. Yeah, I like Dave Ramsey. He's a good guy. I don't agree with everything Dave Ramsey says and does or says, but I do listen. I listen to a lot of the old school guys, right? Guys and ladies, right? So I listen to a lot of them, but I have my own philosophy about some of the things he says, right? And I don't want to dig too deep into that. Let's see. I think I will do that. The rule of 55. Absolutely. Please do your research on that. Listen, I hope this was helpful for you. You have to hit the like button for me. When I close this up, there should be at least 3, 4, 500 likes on this. Okay. Hit the like button for me. That's the greatest thing you can do for me. And share this information with an investor, somebody who maybe it's a young person, maybe it's an older person, but somebody who's thinking about investing, who wants to invest and wants to do it the right way, maybe made some mistakes in the past. This is the type of thing that person needs to hear. They need to hear common sense, practical ways of looking at investment that ain't all hype, that they won't, I'm not standing by my I don't even know what the fancy cars is right now. I was about to say Cadillac, but Cadillac's not even fancy. I'm not standing. What's that Jeep they got? G4. I don't know. I'm not out here on IG sitting on the beach and walking and telling you how to do this. No, I'm sitting here just in front of a microphone trying to explain to you and teach you the best ways to think about investing. This is what most people need to hear. But when you have these type of conversations, they don't get a lot of clicks on it on YouTube, right? Risk management ain't going to get a lot of clicks on YouTube. It just won't, right? Let's see here. Somebody said, no, I missed it. I just get to going with these questions, right? I could go all day on questions, but the link is in the chat to the workshop for next week. Again, you can always go to smartmoneybro.com. You can go to smartmoneybro, the letter U.com. And you can also go check out our book over on Amazon called Manage Your Way to Millions. And that's at manageyourwaytomillions.com. Hit the thumbs up button for me. Drop a comment. Share this video with somebody. G-Wagon. That was it. Yep, G-Wagon. I didn't even know what it was, right? Listen, as I always say, guys, I appreciate you being here. I'm looking forward to see you in the workshop next week. Feel free to drop me a comment. Let me know if you got value from this video. Just say in the comments, I got value, and give me a hit the thumbs up button for me, guys. Listen, and once again, I appreciate you being here and spending time with me. The absolute best person who's going to take care of the old you is not your grandkids. It's not the adult day center. It's not the elderly the elderly home. It's not the government. It's not the president. It's not the mayor. It's not your congressperson. The best person who's going to take care of the old you is the young you, the you today, who you are right now. The 40-year-old you is going to take care of the 70-year-old you. The 30-year-old you is going to take care of the 65-year-old you. As I always say, guys, take good care of yourself and take care of other people. Until the next video, peace.